Welcome to today's broadcast. Welcome to today's broadcast of In Conversation with Dr. Sherry Cooper. We'll be exploring the world of mortgages in Canada and why it's important to have a deep understanding of this topic. To guide us through this conversation, we're joined by Dr. Sherry Cooper. Dr. Cooper is a renowned economist, financial expert, and best-selling author with over 30 years of experience in the industry. She's also the chief economist at Dominion Lending Centres, Canada's largest mortgage company. In this episode, Dr. Cooper will provide us with valuable insights and expert analysis on the current state of the Canadian housing market, the impact of interest rates on mortgages, and the importance of working with a trusted mortgage advisor. We'll also delve into the services offered by Dominion Lending Centres and why they're an invaluable resource for anyone looking to purchase a home or invest in real estate in Canada. So whether you're a first-time homebuyer, a seasoned investor, or simply interested in the world of finance, this broadcast is sure to provide you with valuable information and insights that you won't want to miss. So sit back, relax, and join us as we dive into the fascinating world of mortgages with Dr. Sherry Cooper and your host, the president of Dominion Lending Centres, Eddy Cocciollo.
Okay, welcome everyone to another year of ICW with Dr. Sherry Cooper, our chief economist. Happy New Year. And thank you to our sponsor, FCT. They've been such a great partner and partner this year as well. As expected, a 0.25% drop. And I was really curious on two other technical changes that happened. And Sherry, we talked about it briefly before we started here today, and one was regarding quantitative easing to quantitative tightening. So that was interesting. So that, as you're going to explain to everybody in a second better than I can, is more about liquidity. And the other one that was interesting is this 5 basis points that they put back in to the deposit side. To make it attractive for, I guess it's banks, so there is even more liquidity. So maybe we can start with you being right again. And I think you're now 16 out of the last 17 correct predictions on the Bank of Canada rates. We'll start there, and then maybe you can talk a little bit about those other technical changes that the Bank of Canada announced.
Okay, Eddie, thank you. Well, good afternoon, everyone. Good morning, depending on where you're located. I will begin with, as expected, Bank of Canada cut the overnight rate by 25 basis points. Certainly, it was about a 98% chance of this happening, so we're right on target. That takes the overnight rate down to 3%, which is 200 basis points below where it was last June.
Right.
So, Natasha, can we put the slides up? Great. Okay. Now, looking at the Canadian economy, everything I'm going to tell you right now assumes that there are no widespread across the board 25% tariffs imposed this Saturday on Canada. Now, the Bank of Canada also made that assumption. They assumed tariffs, in fact, were so uncertain that they didn't incorporate them in their forecasts. Right now, I believe that the United States will continue to threaten, to continue to string us along. But what Trump really wants to see is a renegotiation of the free trade agreement between Canada, the US, and Mexico. And I believe he'll get his wish, and probably without a trade war, but certainly, as the bank suggested, lots of uncertainty at this stage. Now, if you look at the growth rates in the economy here, you see in 2024, the growth was a mere 1.3%, and the Bank of Canada raised it to 1.8%. My forecast is 1.9%, but that's within the rounding error. So almost 2% growth in 2025 and in 2026. That compares, by the way, to US growth running right now at about 3.1%. So much stronger in the US with higher inflation, which is why the Federal Reserve has been far, far less aggressive than the Bank of Canada in easing monetary policy. They met again today. I haven't had a chance to see what they actually said, but not expected at all to be cutting interest rates at this stage. So looking at the forecast for the economy in terms of the quarterly numbers, we will see the fourth quarter GDP figure this Friday, finally. And right now, I've penciled in 1.7%. I think the first quarter is going to be strong, around 2.5%. And subsequently, throughout the rest of the forecast horizon, through the end of 2026, growth rates hovering just shy of 2%. Now, the economy's pickup in the first quarter is also a reflection of the checks sent out by the feds and the province, as well as the holiday from paying the GST, which lasts from part of December through the whole month of January. So it's now behind us, but no doubt it had a positive effect on economic activity. Now, Canadian GDP per capita growth has fallen for the fifth consecutive quarter compared to the United States. There is a stunning divergence between the US and Canada. It is truly unprecedented in modern history in every regard, in terms of the interest rates, the currency, the economy, all of it, the housing market, the labor markets are all moving in different directions between Canada and the US. Everything is much weaker, interest rates are much lower in Canada, and as a result of this very unusual circumstance, the Canadian dollar has taken a substantial hit. Now, Canada's economy has underperformed, and therefore so has our labor market. Our unemployment rate in Canada is now 8.7%. In the US, it still has a 4 handle. So a very different set of circumstances. And then the interest sensitivity of Canadians is far greater than for Americans. And you see that in mortgage debt servicing. Mortgage debt servicing relative to disposable income is far higher in Canada than in the US, as even our fixed mortgages do refinance within 5 years, or generally, and therefore Canadians are far more sensitive to movements in interest rates than Americans who have their 30-year fixed rate loans. The job market report was strong in December, although, as I've said, the unemployment rate is high. We've seen an improvement in job creation. Job growth surged to almost 91,000 net new jobs in the month of December, the strongest in nearly 2 years. So that's been good news. And you see that November also showed an uptick in job creation. But the unemployment rate, it fell a tick to 6.7%, but still that's 100 basis points above where it was before the Bank of Canada started easing monetary policy. So these unemployment rates would be even higher still had we not seen aggressive easing. And one other piece of good news in the labor markets is that wage inflation is finally trending downward. Year over year growth in wages was 3.8%, far better than the over 5% wage growth that we saw over so much of the inflation period. And then, of course, job vacancies have fallen sharply. We see job vacancies have returned to pre-COVID levels. So let's talk about the US election and what this all means for Canada. I've certainly given myself a crash course in tariffs in the last couple weeks. I guess it's a week and a half, seems like forever, because this could or would have a tremendous impact on Canada and the rest of the world. There are seismic shifts happening because of the Trump trifecta. And by that I mean Trump has the White House, the Republicans have the majority in the House of Representatives, and the majority in the Senate. And therefore, they can pretty much do whatever they want, with the exception of breaking the law, at least breaking the Constitution. And that's why we've seen judges at federal court levels coming in and stopping some of the initiatives that Trump has already put in place. For example, he wants to eliminate birthright citizenship. Right now, the Constitution's 14th Amendment says anyone born in the country is a citizen and under the jurisdiction of that country. He announced in one of his executive orders that birthright citizenship would no longer be legal, and a judge at the federal level has put an injunction on putting this into place. Similarly, last night, or Monday night, Trump announced through the Office of Management and Budget that he was going to suspend all federal financing of programs and not-for-profit programs in the country. This wasn't going to impact Social Security or Medicare or Medicaid, but many, many, many other programs. And quickly, chaos ensued, as you might expect. And as well, the Democrats in the House and Senate are going to the courts to negate what Trump has said, so that federal funding will flow once again. This affects just thousands of programs and all over the country, in schools, in offices. It is really, I mean, clearly what Trump is doing is asserting that he is in charge. And this time around, he means to dismantle what he calls the deep state, which is the federal government bureaucracy. So Canada exports to the US represent roughly 20% of our GDP. So across the board, punitive tariffs would have a very negative effect on our economy. Trump is also all about tax cuts. He said he's going to use the tariff revenues for tax cuts to help pay for the tax cuts. Immigration, they are targeting the different cities across the country, and raids are now ensuing, and it's only just begun. Deregulation, that's where Elon Musk comes in with his project to eliminate duplication and waste, and many regulations that Musk personally finds very difficult in his own businesses. And then finally, the Federal Reserve. Now, of course, Trump would love to take over the Fed and determine interest rates, but clearly that is not on. So the proposed tax cuts extend what are the expiring tax reductions he initiated in 2017. He's talked about tariffs, everything from 60% on China, 20% on all other countries. Latterly, then he said it would be 25% tariff on Mexico and Canada. Yet we have not seen what exactly this will be. There are those who have suggested that this Saturday he'll make more detailed announcements, and I guess we'll just have to wait and see. The quote is a massive deportation of illegal immigrants, very expensive, but also it's heart-wrenching as well. And he is using federal troops, at least he's hoping to be using federal defense troops to help in the process, and deregulation. Now, to put this in perspective, Canada is the US's second largest trading partner. And this is very important. Canada is the #1 export market for American goods and services. No other country in the world buys as much from the United States as we do. And so to bite the hand that feeds you is, it's contradictory in some respects, but I think he's sending a message that if he's even being as nasty as he is to his continental allies and partners in the world's biggest trade deal, then what is he going to do to countries like Iran or North Korea or, you name it, Russia, China? It's to keep everyone unbalanced, off guard, uncertain about the future. Now, let me present some of the facts that just have not been getting enough publicity. For one thing, Canada has the second lowest trade deficit in goods and services with the US. So you see, in terms of the trade deficit, which Trump makes so much about, because he sees trade deficits as being bad. Whereas what it means is you're getting goods and services for financial assets. It's not a subsidy. It is, in fact, a trade. Canada has a very low trade deficit with the United States. And in fact, if you exclude Canadian energy exports from these figures, the US has a massive trade surplus with Canada. In addition, Trump has said the US is losing $200 billion a year to Canada and characterized that figure as a subsidy. But you see, it's our export of crude oil to the United States, which is refined in the United States and then used in the US or exported by the United States. It is not a subsidy. They receive the oil in exchange for the Canadian price of heavy crude, which is well below the US price of energy. So if there's a subsidy, it's coming from Canadian oil to the United States rather than the other way around. In addition, Canada makes 10% of American cars. And we see that Canada consumes roughly the equivalent number of cars, not the very same cars, of course, but again, we are a big trade partner for the US. The automobiles that are manufactured in Canada, typically they go cross-border, Mexico, US, Canada, many times before the cars are complete. But those that are considered to be manufactured in Canada, in fact, these are American car companies. And they are located in Canada historically because labor was cheaper in Canada, and particularly the pensioners' health care insurance, a whole lot cheaper in Canada, given the government pays for it. So the US manufacturers are boosting their corporate profitability by producing cars in part in Mexico and in Canada. So full onshoring of all non-auto production would require a 75% boost in US production and $50 billion in new factories. Now, obviously, again, this has very negative profitability implications for American companies. And anybody who thinks that the free trade agreement, NAFTA originally called and more recently, think that this hasn't benefited the United States, just look at the stock market. And you can see that it has far outperformed the stock markets of both Mexico and Canada. And that's looking over the past 30 years. In fact, it's going back. We saw the crossover right about just after the completion of the big financial crisis in the US. So nobody believes that trade is in any way unfair to the United States, except, of course, the powers that be in Washington right now. U.S. exports to Canada and Mexico are almost triple the U.S. exports to China. In other words, you can see from this chart, my point is, why are you picking on us? China's the one that has far bigger trade deficit with you than either Mexico or Canada. But this does give Canada and Mexico the power to retaliate, although the last thing we need is a full-blown trade war. Most exports to the US are from US companies who just happen to be located in or have branch offices in either Canada or Mexico. And as I've said earlier, tariffs could well reduce US corporate profits. Now, another announcement that Trump made on the day of his inauguration was that he believed there was an energy crisis in the United States. He said the US needs to step up oil production. Now, oil production in the US in 2024 has been at a record level. Trump says drill, baby, drill policy is profitable. And he's calling for the opening up of drilling in the outer perimeters of the country, as well, the water masses, as well as in public lands. But oil companies are only going to drill if it's profitable. And for profitability, you need to see oil prices at $78 a barrel or above. And right now, oil prices are roughly $73. So he can say what he wants about drilling, but it's unlikely that we'll see that happening anytime soon. The US has plenty of oil, and the real emergency in the US is a lack of power generation. China is already at peak oil demand, arguing that prices will trend downward, which of course precludes the drill, baby, drill. And tariffs slow economic activity. They weaken oil demand and reduce oil prices, which is exactly the opposite of what Trump says he would like to see, although he does want to bring prices down. Now, if he were to impose any kind of restraint on energy flows from Canada to the United States, you could see oil prices, gasoline prices increasing. And even though that may spur further production of oil, it's certainly the opposite of what he would like to see from an overall macroeconomic perspective. So the energy and automobile sectors are number one and number two in terms of Canadian trade with the United States. These sectors would likely be exempt from any tariffs because the US has no alternative sources to meet its demand. Another part of this story is primary metals, including aluminum, food and beverage manufacturing, chemicals, machinery, and aerospace. These are the sectors that are most likely to be vulnerable to potential tariffs. These are the sectors where Canada does have net exports to the United States. Another very important area is Canada's exports of strategic materials to the US. And this would include uranium ore, zinc, tellurium, nickel. The US buys 50 to 80% of critical minerals from Canada. Obviously, they aren't going to disrupt that trade flow. And finally, Canadian tourism in the US yields a surplus of about $15 billion in total service trade. So again, another example of how the US benefits from its trade with Canada. A study was done recently, in fact, by the Federal Reserve, and the Fed officials now have suggested that the biggest effect for tariffs is to reduce growth rather than increase inflation. 2019 was the first full year of tariffs in Trump's first administration. During that period of 2019, the US lost 43,000 factory jobs. Industrial production actually contracted. Business investment stalled. Real median household incomes fell for the first time in 5 years. And it was a hit to consumer earnings, costing consumers a reduction of about $8 billion in income. So it had the opposite effect on the United States that one might expect. Now, our inflation numbers have been better than the US. The December inflation, 1.8%. Now, keep in mind the inflation number would have been higher had there not been a tax holiday for the GST. So the inflation numbers are actually a bit higher than this, but repeatedly in today's press release, the Bank of Canada commented that inflation in Canada is now at the 2% level, the target level, and is likely to remain there through 2025 and 2026. So looking at the actual data, you see that the inflation numbers have come down considerably. This looks at the headline inflation. The core inflation numbers are more disappointing. They average about roughly 2.5% on the varying measures of core inflation, but they've ticked up in the recent past 3 months. So on a 3-month moving average basis, the core inflation numbers in Canada are at about 3.5%, which is more than what the bank would like to see, although they do expect those numbers to come down. And this again just shows you this pickup in the core inflation numbers in the most recent 3-month period. So the bottom line here is that the Bank of Canada cut the overnight rate as we expected, 25 beeps to 3%. They are ending quantitative tightening, which means that they are no longer buying bonds, they are selling bonds they're no longer selling bonds, they're buying bonds. So they're adding liquidity, they are driving market-driven interest rates downward. And I believe that monetary policy is still restrictive and that they will continue to cut overnight policy rates by increments of 25 basis points, and that by spring of this year, we will see the overnight rate at 2.5%. This shows you why I say that monetary policy is still restrictive. The overnight rate is at the overnight rate is 3.0%. Headline inflation is 1.8%. So the overnight rate is still 120 beeps above the current level of inflation. Average real rates of the past 30 years is just 60 beeps. So an overnight rate is likely headed for 2.5% and maybe even lower still. And this shows you the prime rate. With the overnight rate at 3%, the banks will likely announce the prime rate coming down 25 basis points as well to 5.2%. Good news for the housing markets, and continuing good news, I believe, as we see further rate cuts by the central bank. The Canadian and U.S. central bank policies have diverged tremendously. Overnight rate spreads, Canada and U.S., are about 140 basis points. The Canadian overnight rates are 140 basis points lower than the U.S. This is a record gap, and it is part of the reason why the Canadian dollar is trading at 69 cents US. We have seen our bond yields come down again. Interest rates, market-driven interest rates, moved up for a few weeks, particularly after the Trump election. There was the Trump trade, which saw money flowing into the stock market and out of bonds, and that raises bond yields, but it was temporary. Right now, the 5-year government bond yield is 2.87% compared to the December decision date of the Bank of Canada. The rates were 2.84% back then. So very little change in the 5-year government bond yield on balance. Although over that period of time, the interest rates have come down quite a bit. Now, these are future decision dates. With 3% overnight rate today, we're likely to see 2.5% by April or at the latest June of this year. This will mean a strong spring selling season as well as rising new listings for sellers. So the overnight rate headed for 2.5% by spring, but this is above the pre-pandemic level of 1.75%. Now, we all know about the payment shock that's happening with refinancing mortgages. Renewing, refinancing, half of Canadian mortgages are coming up for renewal in the next 2 years. The good news is, though, that people had to qualify, at least those who borrowed from federally regulated financial institutions had to qualify at 200 basis points above the contract rate. So yes, it means that households are going to be paying more for their mortgages, but the interim period, they can afford to do this as well. Incomes have risen over the interim period. So finally, let's look at housing. The December numbers weren't great. And in fact, the latest numbers coming for January for Toronto also are not great. Sales numbers have dipped. And what we're seeing is that, though keeping in mind December and January are very weak months, seasonally weak months for housing, the fact that in the 10-year moving average of monthly home sales is now roughly equivalent to the actual sales data. That's really an improvement. You can see the pattern, the monthly pattern typically, and January and December, very weak sales months. I'll get back to new listings. In the fourth quarter, new listings edged down slightly. I expect them to move up in coming months. Market balance, we've got sales to new listings ratios, months of inventory, all suggesting roughly balanced markets in most parts of the country. And this shows you the multiple listing services home price index, and you can see that on a year-over-year basis, we've had pretty flat levels of average prices. Right now, of course, as we prepare for what we hope is a very strong spring selling season, people will be making decisions on fixed versus variable rate loans. And while variable rate loans were not popular over the course of the time when the feds were raising interest rates, only 50% of new mortgage borrowing was in the 3 to 4 year fixed rate loans. 23% are fixed less than 3 years, and only 10% is fixed for 5 years or more. But the numbers haven't shown it yet, but anecdotally, I've heard that variable rate loans are starting to pick up again. And the obvious reason is because the spreads between fixed and variable have turned negative. And you can see that in the first chart, and the forecast curves as well suggest that variable rates 1 year out will continue to fall for at least the next 2-3 years. And that's much more than we'll see in the fixed side. Now, another big development, and one that I certainly wouldn't have expected, is the massive slowdown in population growth in Canada. The immigration targets have been slashed, and the government has complied not only with these targets, but even more. So I'll show you what I mean by that. In terms of planned permanent immigration, we saw for 2025, the original forecast had been a target of 500,000, which they've reduced to 395,000 and 380,000 next year, and even less the year after. But it's not the permanent residents that are of concern to the government, because those are relatively small numbers in comparison to temporary entrants. More than 800,000 temporary workers and foreign students were accepted in the year ending 2023. So those are huge numbers. Temporary residents surged since mid-22. That would include foreign students, temporary workers, and asylum claimants. So Ottawa announced months ago that it planned to slash the number of temporary residents. It wanted to reduce the temporary residents from 7.2% of the population to 5% of the population by next year, which would mean that 2.4 million non-permanent residents would have to leave in the next 2 years if they aren't granted permanent residency. And the number of permanent residents target has also gone down. Foreign student permits have plunged way more than planned. They announced they would reduce those foreign student visas from 650,000 issued in 2023, they wanted to see it come down to 364,000 in 2024. Instead, what we've seen is 280,000 in 2024, which is a 45% decline. So that is really quite stunning. Population growth is already slowing, whereas we saw population growth well in excess of 4% in 2020, in one quarter of 2023. Right now, there's 1.7% population growth. It's the slowest in 2.5 years, and likely to decline further. Now, what this does is when immigration slows, it reduces both demand and supply. On the supply side, what are we going to do about the labor shortages in construction or in agriculture or in healthcare? What about seasonal workers? Most of these will be temporary foreign workers hoping to become citizens. So that is one factor that will continue to be an issue. In addition, as population growth slows, rents begin to fall. And we've actually seen rents fall 3.2% in 2024 to a 17-month low, which is also incredible and tells you the power of net immigration. And then finally, slower population growth reduces economic growth and reduces inflation. And that too is consistent with lower interest rates. So, Eddy, I think that all signs point to continued uncertainty and volatility, but I still think the net trend for interest rates in Canada is downward.
Yeah, and I agree, and I want to spend a little bit of time on just talking about variable rates and what the rate environment right now is doing. So for those of you that are tied into a variable rate or adjustable rate, you saw either your payment come down today or your principal payment go up and your interest payment go down, depending on if you're on a variable or adjustable. So you hear Dr. Sherry Cooper talking about it going down to 2.5%. It's at 3% right now. So by the spring, which is only a few months away, I hope, because it's very cold here in Toronto. So we're looking forward to those spring sunny days and those lower interest rates. Right now, you're looking at a prime rate around 5.2. That's the sort of the rate that's in correlation with that 3%, and it's going to go down to 4.7, so that's 0.5%. Now, that is saying that the banks are going to absorb exactly, and as you know, Sherry, they don't always follow. They have in the past where they reduce less than the Bank of Canada, but I think they will match Bank of Canada. So you're looking at about 4.7, and it's very common for variable rates to have a discount further from there, meaning it's a prime minus situation. So if you have a mortgage broker that's negotiating for you, they're going to negotiate that prime minus. You've heard of prime minus 0.5, prime minus 0.75, maybe even prime minus 1. So that would come off the 5.2 today or the 4.7 by the spring. So as you said, Sherry, all factors are pointing to lower interest rates. So taking advantage of a variable rate, adjustable rate isn't a bad idea. But it all depends on your situation. So you do want to run your scenario by a mortgage professional. Of course, you can visit www.dominionlending.ca and we can connect you with a mortgage professional. They can go through all sorts of scenarios and ensure that you're comfortable, ensure that you're making an informed decision. And of course, your mortgage broker would be fighting for you to get the best rate and the best product possible. So I wanted to get that out of the way before we got into questions. You talked a lot about tariffs. I guess I expected that, Sherry, with all the talk in the news of tariffs. And you and I talked about it. We're hoping it's just him posturing, Trump trying to be a good negotiator, with NAFTA, or the USMCA coming up. I'm sure he wants to position himself. So it's all that in my eyes. I hope it's that, but you never know. Tariffs could come in, and if it does, then the Canadian government will have to combat that. And one of the ways is even lower interest rates. And I think we even talked about possibly going below 2.5 for the year, maybe even start with the ones. Is that possible in your eyes, that if tariffs come in, there's challenges with the economy, that prime rate can be, 1.5 or 1.75 by the end of this year?
Yeah, it's possible. For sure, we're close enough to a tipping point that something as aggressive as substantial tariffs would certainly be a death knell. We would likely see a recession pretty quickly.
Yeah, and inflation obviously is one of the combatants that the Bank of Canada wants to ensure that inflation doesn't get out of control. And they said something in their announcement today, and I think you said you didn't read it, so I'm going to read it to you. It says excess supply in the economy is gradually absorbed over the projection horizon.
Right.
That means there is more room for inflation to come down. If it's excess supply, it's not excess demand. That means it has to get absorbed, and that's going to be when inflation comes down, correct?
Well, excess supply drives inflation down.
Right.
Okay, so in that respect, yes. And it'll be interesting to see what a substantial slowdown in population growth does, because we all know that it contributed to the housing shortage and the run-up in rents. And now we're likely to see a reversal of that.
Mm-hmm.
And I really have been surprised at how quickly they've been able to reduce temporary workers and temporary students.
Yeah, it's amazing how those numbers can be very, very large and somewhat lot smaller just from words, right? Announcements. Okay, so let's get to some questions, Sherry. The first questions are from our friend Jason Nugent. Hey, Jason, hope you're doing well. Happy New Year. If tariffs are implemented, how long could they realistically last? So is it a threat, and then a threat that has to come into fruition because it has to, and then kind of gets pulled back, or will it last?
Well, it's obviously my crystal ball doesn't work any better than anyone else's, but I think it would be relatively short-lived, because the whole point of this is to address whatever the grievances are in the free trade agreement with respect to the United States. There's got to be a compromise made, and it's pointless, really pointless, to drive a real wedge between Canada, US, and Mexico, because we've been so successful in creating the kinds of comparative advantage uses and improve corporate earnings in the US. So, but given the administration, given they want to break things and they don't mind chaos, anything's possible. And that's the uncertainty.
When I think about what are the guardrails for Trump? Well, not re-election, because he can't be reelected, correct? Because he's already served one term. This is their second. So that won't be a guardrail. I don't think he cares about the Senate or anybody else for that matter. So is he going to be rogue and do what he wants? Like, what are the guardrails? Is it like, who's going to keep him in check? It's just.
Well, the Congress and the courts are supposed to.
We know how that worked in the past, right?
Right.
Okay, let's get to our next question.
He's a lot smarter than he was the last time, because a lot of very smart people have been working on this plan, this Project 2025, and some of the people that wrote that plan are now working for Donald Trump. And you better believe they're going to try to implement it. That's exactly what they're doing. And we'll see. I mean, the Supreme Court has already said that Trump cannot be held accountable for any actions taken in, in his role as president. So even though he is announcing things that are not constitutional, that's okay in a sense, because nobody can get at him, except to the extent that they can determine if this whatever action is indeed constitutional. And that could go on for months and months and months.
Okay, well, Rob Reese just made a comment there. He also has a question. It appears lenders are holding their margins higher than usual compared to the bond yields. Do you see this continuing for much longer? Interesting. Usually a spring market campaign or spring market push comes to fruition every year where banks become very, very aggressive. I don't see this spring being any different. So they'll eat away at that sort of margin. But what are your thoughts?
Well, let's hope so. I agree. And it'll be just in time for the economy too, because we really do need to see a pickup in activity.
Yeah.
So I think all systems would point to lower interest rates, stronger housing. And then what that means in terms of household spending depends on whether people keep their jobs, and likely they will, unless we do see across the board meaningful tariffs.
Yeah, Alejandro Luca asks, hi, Dr. Sherry Cooper. Based on historical inflation cycles and current economic indicators, do you see any possibility of a second wave of inflation emerging this year or next? If so, what factors such as monetary policy, supply chain disruptions, or geographical risks would most likely contribute?
Well, the first thing would be an imposition of import taxes or tariffs. And that initial effect is to raise the cost of imports. And that's supposed to encourage people to buy domestically produced goods, as well as increase just improve their productivity. I don't know how many degrees of freedom Canadian businesses actually have. There's only so much you can do with what you've got. And given that we export 70% of all exports to the United States, they really do have us in a tough situation. But as well, many states in the US export their products to Canada and would like to continue to see that happening. And that's where the retaliation comes. If we were to say, no more cheese from Wisconsin, no more whiskey from Kentucky, no more, you get the drift. So.
Yeah. Okay, let's go to Monique Maricot. Hey, Monique, hope all's well. Happy New Year. I think she's asking about inflation, the inflation levels. Canada could be in a nasty recession. Do you feel like we're heading that way? Rates going back up to an intolerable level. I don't think rates would go back up if we're going to a nasty recession. I think it would be the other way around, I believe. And you're saying Bank Canada is going to continue a downward trajectory. I do believe we are going to see rates decrease, no doubt. I guess you're just asking for your thoughts on that.
Right. Well, I think I went through why I think what I think. Anything can happen, no question. We've got lots of uncertainty, lots of volatility, but Canada is a small fish to fry for Donald Trump. Everyone knows that. The real concerns for him are the biggest component of the U.S. trade deficit, which is China. And there already are tariffs on Chinese products, and no doubt more to come. And the Biden administration didn't remove them. So that's really where the potential lies, much more so than for Canada.
So Croft, Hey Croft, Happy New Year. I kind of went through the variable rate discussion, but he's asking about the discounts from Prime and if it's banks pricing or is it a profitability decision? I guess it's a bit of both, but do you want to take that on and
Well, it's like you said, the banks aren't competing as aggressively as they could. As we get closer to the seasonally strongest time of the year, I think the strongest month is May, but as we move closer to May, June, April, I think the banks will, at least one of the banks will step to the plate and try to buy market share, and that'll trigger the others to do so as well.
It's interesting. I think the banks didn't do the full discounts a couple of times in the last, say, decade, maybe less. They never gave that back. It's not like they reversed that. So that, and we'll call it profitability because there's no other really real word to use there. So that profitability is still in the system in variable rates. And, some of them will discount the variable more than others. And so that will eat into that sort of profitability, and maybe they're giving it back to consumers. But on a advertised rate, they've never given that back to the consumer. So if you are in a variable rate or arm, those discounts that weren't matched, so I think it was 0.15 instead of 0.25 at the time. And if you want to comment and remind me what they were, that was never given back. And they can do that again. There's nothing stopping them from necessarily doing that again. And the other piece is the prime minus, right? So prime minus, we've seen 1.1, 1.2 in the past. One prime minus half to 3/4 seems to be the norm. But again, those are all negotiated items that you'll need a mortgage broker, a really good mortgage broker, to help you with that. So if you are a consumer looking for that variable rate discount, highly recommend you visit dominionlending.ca and we'll find a broker that will help you do that. Okay, let's go to the next question. We have a few more minutes. We're going to go to Peter Paley. Peter, how are you? Hope you're all's well in the great province of Manitoba. If the U.S. imposes tariffs and the loonie devalues, could our exports and exporters still benefit, or would the impact of tariffs offset any potential gains by the lower dollar? If Canada retaliates for a dollar tariff, and that's the question. If we do retaliate, isn't that just a spiral of all of it going down and then a global, right? So maybe you can just give us an insight of what those scenarios would look like if we matched.
Well, the point that Peter has made first is totally correct, which is tariffs will hurt the Canadian dollar, which means our products are more competitive in the U.S. They're cheaper in the U.S. I believe that if the Canadian dollar continues to fall, we'll see a lot of tourism by Americans into Canada. So that's an offsetting second order effect of tariffs. And generally, these things equilibrate. We had years and years of globalization, and now we are appearing to unroll or roll that back somehow. And yet so many product prices are determined in global markets. So whether we like it or not, we're in this together. The US dollar has been extremely strong, not just vis-a-vis the Canadian dollar, but vis-a-vis virtually every other currency in the world. The US benefits significantly from having the world's only reserve currency. Whenever there's any kind of volatility, uncertainty, a big increase in uncertainty, you always see a flight to the safe haven of U.S. Treasuries, which reduces U.S. interest rates, increases the U.S. dollar. And that's exactly what we've been seeing. So as much as Trump wanted to say that the United States, until he became president this time, was in terrible shape, The U.S. is not in terrible shape. The U.S. is the envy of the world when it comes to economic performance and financial performance. Look at the stock market.
Yeah, absolutely. Okay, so let's go to a couple more. We got Sean Humphreys asking, Scotiabank has forecasted that the Bank of Canada will stop at 3%. Sometimes Scotiabank can be wrong. Citing consumer spending is stronger than what is being reported in the Canadian statistics. Is the Bank of Canada considering this stat?
I don't believe this is correct. Derek Holt has a very strong point of view, but I beg to differ. I think that 3% overnight rates is still very restrictive, and we don't need to be more restrictive at this point, and particularly so given that our population growth is declining.
Yeah, absolutely. And listen, Scotia will bank, and some economists will make some predictions that could happen, and so that it could happen. But a way that you're seeing things, Sherry, is they're going to go down to that 2.5 and maybe lower depending on some factors. But it'll be interesting to see how that plays out. So Sean, I don't know if Scotiabank's right there, but I think we're headed for 2.5, bud, which is good news for you and good news for the mortgage holders of variable rate mortgages. Okay, so one more. We're going to go to Alan. Do you feel that if the tariffs do come in, that fixed rates won't be under upward pressure? I see prime falling, but fixed rates based on the U.S. 10-year. So that correlation between the U.S. and fixed rates or the bond market still exists, and the U.S. is doing strong. But if tariffs come in, will that change?
Well, right now the 10-year yield is at 4.6%. In the U.S., our 10-year yield is 3.2.
Okay.
That's unbelievable. Really unbelievable. And so our rates are already lower, right, and likely to fall further. And if the U.S. economy slows enough, the U.S. rates will fall further. But remember, U.S. inflation is still 2.9%, where the comparable for us would be 1.8.
Well, Sherry, as usual, thank you so much. Your insights are always so valuable. For anybody looking for some advice, please visit dominionlending.ca, connect with a mortgage broker, get them to help you with your current lender, with your current situation, for future purchases, whatever you need when it comes to borrowing, we can help you. Really appreciate everyone. Thanks again, FCT, for sponsoring. Until next time, which is March 12th, I know that date well. We will reconvene then. Thanks, everybody. Thanks, Sherry. Take care.
Bye-bye.